so let's talk technical analysis. In this video, you're going to be learning about how to read candlesticks, how to understand market structure, interpret the data that you're reading, and more importantly, how to set up your trades so you guys can maximize your reward and minimize your risk. You'll be able to take a look at this chart and see what I can see. The market structure, is it an uptrend, is it a downtrend? You'll be able to find the areas of supports and resistances that will allow you to have the best chance to win. You'll be able to read the candlestick patterns that will allow you to determine if there's bullish or bearish intent. And more importantly, you'll be able to find the correct entries to allow you to minimize your risk by setting up the correct stop losses, as well as maximize your reward by figuring out the optimal take profit. I'll be using a lot of my own examples from stock trading and options trading because that's predominantly what I trade, but know that this theory or these skills can be used for other markets like Forex and futures. Now, if you guys like content like this, make sure you guys like the video. And this course did take a long time to make, so if you guys can consider subscribing to the channel, that would really help me out. If you guys have any questions at any point in time, let me know down in the comment section below. And if you guys ever need to pause the video, come back, revisit a different section, all of the timestamps are below. All right, so let's get started. First things first, what exactly is technical analysis? Most people think that technical analysis is really about predicting the future. You see a candlestick pattern or chart formation, you go, the stock will have to go up or down from here. But that's actually the wrong way to look at it. TA is really about learning how to stack the probabilities in your favor by really understanding your risk and reward. And you're going to hear a lot about risk and reward in this video. There's actually academic studies that have proven technical analysis worth. In 1992, there's a study that showed that simple trading rules like moving averages and breakouts produce better returns than random chance. In 2000, a research paper from MIT found that some chart patterns like head and shoulders that we'll talk about later in this video and double bottoms really do carry statistical significance. And even more recently, in 2007, Park and Irwin reviewed about 100 studies and found that more than half showed TA was profitable in a lot of different markets. TA isn't necessarily just a crystal ball to predict the future. It's about giving you a framework, a strategy, so that you can understand your risk and reward. And this, combined with emotional discipline and experience, is what's going to give you an edge in the market. So let's start with the very basics, the building blocks of TA, and that is the candlestick. A candlestick will tell you how much price has moved within a certain time frame. And every candlestick, like you see on the chart right here, are made up of two parts, a body and a wick. The body will tell you the difference between the open price and the close price within a certain time frame. And the wicks will tell you how far or how high and how low price has moved within that certain time frame. Let's take an example, this bull candle right here. Price opened at $95, it went to a low of 93, and then pushed up to a high of 100, and then closed at 98. So the body will show you that the price opened at $95 and it closed at 98. And the wick will tell you that it went all the way down to 93 and all the way up to 100. It will tell you how much prices move within that certain time frame, while the body will show you what the difference between the open price is and the close price. Now let's take a look at the bear candle. The bear candle will have the same part, body and wick. The only difference now is that the candle is going to be red because price closed lower than where it opened. So in this case, price opened at 98, it went to a high of 100, it fell down to a low of 93, and it closed at 95. So let's understand why prices go up or down. And it ultimately comes down to this one concept called supply and demand. So let's take, for example, there's a Rolex on eBay that I really want to buy for 10 grand. Now, I really want that Rolex, right? So I'll put in the bid for 10 grand. Someone else might come in and go, I want it for 10.5. I'll be like, okay, maybe I want it for 10.75. Someone else will come in for 11. And we'll keep raising the price up because we both want it. At some point in time, one of us will bow out, right? And let's say it's at 12 grand. And the seller will sell it to me at 12 grand. But you can see in this example, price has gone up from 10K to 12K because there is more demand than there is supply. In this market, you can see that the buyers are in control because the buyers are pushing the price up. Now on the inverse, let's talk about maybe another situation. I'm looking to sell a Pokemon card, right? A vintage Charizard, maybe for $100. Put it on eBay, but no one is actually buying it at $100. A week later, I drop it to 99. A week later, I'll drop it to 98, maybe 97. And then at 95, someone steps in and buys it. And you can see that price dropped from $100 to $95 because there was no demand at 199, 98, and then finally there was demand at 95. Supply is greater than demand, and sellers are in control of the market. So prices rise when demand is greater than supply, and that shows you that buyers are in control of the market. Prices fall when there is greater supply than demand. Therefore, sellers are in control of the market. Supply and demand, you'll hear these words a lot in this video. That will be the driving force behind a lot of what we talk about later on. All right, so let's take a look at a couple candlesticks of different sizes, wicks, and bodies. Let's take a look at this first one right here. You can see the body is relatively large and the wick is relatively short. Market started here, price got pushed down, but it got bought all the way back up and pushed all the way up to this point right here. And this is a very large body. So what does this tell us? This tells us that there is far greater demand than there is supply, right? Buyers are in control of the market, therefore pushing price up. And this is a very bullish signal, right? People are scooping up shares because they really, really want to buy this stock. Now let's take a look at the second one. Very large wicks, but a very small body. What does this tell us? Price went down, it was shot all the way up. There was a decent amount of strength there. And then the weakness came in and price sold off to be slightly above where it opened. Now, is this bullish or bearish? If you take a look at this candle, you would look at green, you might go, it's bullish. But in actuality, this is actually a pretty bearish signal because the buyers were not able to control the price and sellers stepped in to push price all the way down. So let's take a look at this next one right here. This one has smaller wicks and a smaller body. So this is a bullish or bearish signal. Price opened here, it sold off, but then buyers stepped in to push the price up and it closed higher than it was before. In this case, this is a more bullish signal because price was able to stabilize above the close price and all the weakness that we see on the wicks was bought up and the buyers were able to regain control and push the price up. So this is a relatively bullish signal. And again, you can tell every candlestick is telling a story. So let's take a look at the bear side. Is this a bullish or bearish signal? Let's take a look. And I'll give you guys a couple seconds to think about it, and then we'll go through it right now. So in this case, price fell all the way down to here, right? So there's a lot of weakness, even though there's a higher wick here. Price got pushed up. There was no more buyers. Sellers decided to step in and control the price, and price fell all the way down, way below where it opened. So this is a bearish signal. The body is relatively large, and so this shows a lot of selling power during this time frame. Now let's take a look at this. Is this a bearish signal or bullish signal? Right? Very long wicks, relatively small body. Pretty similar to the previous one, only in this case the body is red. So price ended up lower, even though price was pushed all the way up, but the sellers regained control and took over and pushed price all the way down. This is actually an extremely bearish signal, and this is what we will call a shooting star, which we'll learn later on in this video. Now let's take a look at this one. Thin wicks compared to this one before and a thin body. Does this tell us bear or bull? And when I see this one, this should show you that there's just actually a lot of indecision in the market. Why? Price pushed up, price pushed down, the wicks are equal sizes on both ends. So the buyers and sellers are fighting for control. Right? Even though it ended up slightly lower, it doesn't indicate that there's a lot of selling power because neither one was able to push price all the way down or all the way up, similar to what you see here or here. So this is a relatively indecisive candlestick, very close to what you'll learn later on. It's called a doji. You can't necessarily look at just the color of the candlestick to determine whether or not something is bearish or bullish. You have to look at the candlesticks, the wicks and the bodies in context to other candlesticks to understand what has happened during that time frame. And hopefully this demonstrates the principle of supply and demand, sellers in control or buyers in control, so that you guys can really understand and interpret what is happening during that specific time frame using candlesticks as the unit of measure. Now that you know how to read a single candlestick and interpret it, let's take a look at some of the most common candlestick patterns that you'll see trading. The goal here is not to memorize these shapes. It's really to understand the psychology behind the movements so that you can interpret it in real time when you guys see this in your charts. And the first thing that we'll talk about is the hammer. And the hammer is basically named hammer because it looks like a hammer, right? A long wick with a body at the top. Now, this is basically a bullish reversal pattern. Price rejected a low and pushed all the way up and closed higher, right? Which means that sellers were able to push the price down, but buyers were able to buy up that weakness and push the price even higher. So this is a very, very powerful pattern, especially when it's an area of support or demand. The next one here is what we would call a shooting star. It's basically the opposite of a hammer. The wicks are really tall up here and the body is at the bottom. This is basically the inverse of a hammer because there's a lot of strength that came in, right? Buyers were in control. And then the sellers took over and continued to sell off, and the price fell until it fell lower than where it opened. So this is a very bearish signal, a bearish reversal pattern. This one right here is what we were alluding to earlier. This is what we would call a doji. It's an indecision candlestick because the wicks are basically the same size on both sides, and the market didn't open or close any higher. It closed at the same price as it opened. Therefore, there's a lot of indecision with buyers and sellers fighting it out on that specific candlestick. So let's combine a couple candlesticks so you can see how two candlesticks combined can tell a whole different story. So let's take a look at what we would call here a bearish engulfing candlestick. The market was able to push itself up and form a higher high on that time. So it was a green candlestick. With a subsequent candlestick afterwards, the body became really, really large and the market started selling off. And this is a very bearish sign because not only was the price not able to close up higher, it fell, and it fell very fast, and it fell at a much larger, it fell to a lower price than what it was previously. So this is what we call a bearish engulfing because the body engulfs the previous candlestick. On the other side, if you look at a bullish engulfing candlestick, it's the same idea. Price closed lower on the previous time frame, but the market bought up that weakness and closed higher. Again, the body is very, very big, which shows a lot of bullishness, a lot of strength. And this is what we call a morning star. You have a bearish candlestick, an indecision candlestick, and a bullish candlestick. What this shows us is that the market sold off. There's a lot of indecision. The market was fighting to find a winner, and then the winner was found on this green candlestick here. This is bullish because it closed up higher than what it was 2 periods ago, indicating that the buyers have stepped in to control the market. On the flip side, this is what we call an evening star, right? It's a bearish intent. You can see that the market tried pushing it up, indecision stepped in, which means that there's not enough buyers to continue the upward momentum, and then the buyers ran out and the sellers stepped in and controlled the market. Again, this is a very bearish signal and usually indicates maybe a reversal pattern. Here we have what we call the 3 white soldiers or 3 soldiers. It's basically 3 candlesticks that have wicks that are higher than the previous ones. You can see this one wick is down here, but this one starts up higher, it ends up higher. Same with this one ends up higher, and then the top wick ends up higher as well. It shows us that the sellers are not able to push the price lower than the previous candlestick, which means that there is sustained buying power or sustained strength in this movement, which is, again, a very bullish signal. Now, if you flip it to the other side, this is what we call the 3 black crows. It's just the inverse, right? 3 candlesticks where the wicks are lower than the previous candlesticks, and it indicates that the buyers are not able to regain control, and the sellers are still in control. Buyers try pushing the price up, but sellers maintain control and push the price down on all 3 subsequent candlesticks. And again, this is a very bearish signal. So these are just some candlestick patterns that I like to use, that I like to look for. You'll find what works for you. You'll find what resonates with you. But just remember, the psychology behind these candlesticks are a lot more important than the actual candlesticks themselves. Now I'm going to head over to the chart and we're going to try and locate some of these patterns. For example, right here, you can see this might be a hammer right here. But this might be an evening star right here, right up, down, and a large body. This could be here a bearish engulfing, another three soldiers, a doji's right here. This is a mini hammer, a bearish engulfing candlestick. Let me know down below if you find any other ones. We're just going to do this for a couple of stocks. So instead of maybe we hop over to the S&P 500 and we'll, instead of going on a daily, let's just go to the 1 hour, for example, and we're going to look right here. This is definitely a large body candlestick. Right here is a bullish engulfing. This is kind of like the morning star where it's reversing upwards. This is a shooting star right here. See, there's a doji somewhere. This is a doji right here. You see right here? Yeah. So this is sort of like a hammer, but it's a lot smaller than this one. Let's go to another one. Let's go to, let's see, everyone's favorite stock, Tesla, for example. Tesla's also a lot more volatile, so you probably see a lot more large body candlesticks. And maybe instead of the hour, let's go down to the 5 minutes, right? We're day trading now. And let's zoom in on a previous day. This right here could be considered a bullish engulfing candlestick, right? There's some indecision here, and then it popped up, large bodied. This is like a 3 black crow right here. This is sort of like the morning star, but it didn't really form. There's a doji. Here, maybe a bullish engulfing here. There's a really large doji right here where my cursor is. That's pretty impressive. This is a bearish engulfing right here. Do hymns. Instead of 5 minutes, let's do a 30-minute. And we'll zoom in maybe on a couple of 30-minute candles. Let's see. This could be a bullish engulfing candlestick. This is definitely a hammer. You can see how large the wick is. This is what we would call a morning star. Really easy to identify this one. The 3 white soldiers, three black crows. This could be considered another hammer, another bullish engulfing candlestick with 3 white soldiers. We keep going. This is a shooting star right here into a bearish engulfing, which is a good sign for a short play. Another 3 black crows. See a lot of bearish thing. This is a large body candlestick. And maybe a doji here, right? That in itself really isn't that important. I'll take you to the next step about how to use it and when to use these patterns and what they mean and how they can help you improve your trading. You can tell, like when you look at the charts, these patterns don't form as cleanly as we were doing when we were in practice. So sometimes the wicks are kind of large, sometimes the wicks are kind of short, sometimes the bodies don't exactly form, like maybe it's not large enough, maybe it's not small enough. That's a very important point because these patterns that you're learning, these candlesticks, will not show up cleanly every single time. And so intuition, as well as being able to interpret the market flow on the day, is going to be very important. And so that's going to be the next couple of steps that we're going to learn in this course. So now that we know how to understand candlesticks, let's take it to the next level. You want to learn when to be looking out for these candlesticks. And so in order to do that, we have to understand market structure, which is understanding the trend of the market. Is it an uptrend, downtrend, or if it's going sideways or consolidating? And there's a very easy way for us to understand that. I like to call this the ABCD pattern. And I'll show you guys on the screen. A very easy way for us to tell if something's in an uptrend is to see where the highs and lows of the market are. So for example, you can see this is a low to a high, which is our A to our B. And B will be our high to our C, which is our higher low. And then C to our D, which is our higher high. You can keep doing this, high to another low, to a high, to the low to a high, right? You keep going this, you see this, right? Okay, so you'll see that this is an A, B, C, D, E, F, G, H pattern, right? A, B, C, D, E. So this tells you that the market during this period is in an uptrend. So let's take a look at where Costco is right now. High to a low, to a high, same high, to maybe a higher high, to a higher low, and it's kind of just here. So A to a B to a C to a D. So here you will probably say that the market is going sideways, it's channeling, it's consolidating, waiting for the next big move. You can also do this for like currency pairs. So again, what we want to do here is practice. So we'll take a look at this and see if we can determine the trend on this currency pair, which is USD Japanese yen. What we do is you look for the low here, and it goes all the way up to a high. So that's A to B, and it fell back down to a C, which is a higher low, and now it's pushed up to a higher high. So you can see the trend here in this currency pair for right now is in an uptrend. And the psychology behind this is really interesting, right? It went from a low, buyers remained in control, and then the sellers started selling it off, but it wasn't able to push it past the previous low which means that the buyers then regain control and pushed it even higher. This is the uptrend that we're talking about, right? Because it's going higher and higher and higher. But here's another example. USD and Japanese yen on this time period is the inverse. It starts from a high, it went down to a low, it pushed it up to another high, right? A, B, C, but it wasn't high enough. It was a lower high, and then the market sold off to a lower low. A, B, C, D. So Japanese yen USD pair during January all the way up to February here is in a downtrend. And you can see continue to draw it, A, B, another downtrend C, and this is still in a downtrend. The logic is exactly the same. Market started high, sellers took control, buyers tried pushing it higher, but it failed, and it pushed it lower. Buyers tried again, it pushed it lower. So this again is in a downtrend. Again here, it tried going higher, and it failed, and it went even lower. From the psychology that higher highs, higher lows, or lower highs and lower lows will allow us to determine the trend of the market. We can do it one more. So 1 minute, right? And you can see some uptrend to a lower high, to a higher low, higher high, sorry, and the market moved down to a low, and then the market didn't break any higher, went down, right? An inverse, so it's A, B, C, D. It formed a higher low, but wasn't able to form a higher high here, went down, now it's a higher low, so now it's in a downtrend, and it kept going in a downtrend until maybe, see, I'm just drawing this out. See, still downtrend all the way down here, right? So A, B, C, D, E, F, G, H, I, J, K, L, right? Like you can just tell, market buyers came back, sellers sold off, buyers came back, sellers sold off, buyers came back, sellers sold off, buyers tried, sold off, sold off. This is the power here. And at the end of the day, you can see buyers stepped in, pushed it high to the same previous high, then tried forming a higher low, almost did it, and now it's trying really hard to form a higher high. And then we'll see if we're day trading the day afterwards if this forms a higher high. But you can see how powerful this is to understand which trend is happening on whatever time frame that you're looking at. Now, you can kind of tell there's a little bit more to this than just understanding the trend. It leads us to the next step, which is understanding where these higher lows and higher highs might form. And this is where we call supports and resistances, or areas of supply and demand. One thing you'll notice is that when we look for these trends, that you have your low to your high to your higher low to your higher high, sometimes it doesn't look necessarily like this, right? Sometimes it looks more like this and then this. But this higher low, the way you look at it is to find the lowest point on the chart. In this case, it'll be this point. You draw it there, and then this part here is just consolidation waiting for an upswing to the higher high right here, right? And you saw that with some of the other examples that we just went through, for like the SPY example on the 30 minutes. But this will help you identify what the low and highs of the days are, is by understanding these areas, which leads us to the next part. When we look at these higher highs and higher lows, you can see that they form these areas of reversals or supports, right? And these areas right here are what we call areas of supports, is where price jumps up, and resistances is where price falls, right? So from a low to a high, it hit a resistance, fell back down to a low into a higher low, which is our area of support, which then go up to a high, which is then a resistance. And you can see this pattern continue down, right? And this is another higher low, so it's a support. These are actually the next step in understanding market structure, is these areas of supports and resistances, otherwise known as demand and supply. So demand and supply. Supports will typically want to push price up, and resistances will try to push price down. So the reason that price rejects an area of resistance is because people are usually trying to take profit there. They're selling off their shares and realizing their gains. And then price bounces off in areas of support, otherwise known as demand, because then people think that this is a good price to get back into the market, therefore buying up shares and pushing price further up. Learning how to identify these areas of supports and resistances is a very important skill. And we're going to demonstrate that right now, like going back to the charts. So you can see price rejected right around here. So this will, and then fell back down. This right here will be an area of resistance. Okay? Price rejected off of this part, so this will be an area of support. And you see price rose back up and then we tried fighting around this area and then it ultimately started falling back down. So you see this is also an area of resistance. And by drawing this out, you can see as I'm drawing it through the wicks, trying to touch the wicks as many times as possible, 1, 2, 3, 4, 5, maybe 6. You can see that here is also an area of resistance, right? Price came up, came back down, came back up and sold off. Now you'll see something really cool here. This right here is an area of support, right? And if you guys remember, this right here, this is a previous area of resistance, right? And if you see what happens, it becomes an area of support. Resistances and supports tend to be intermingled with each other. This area of resistance now is an area of support, which you can see it touches once, twice, and 3 times. Area of support. We'll talk about our trading system later on, the exact trading system that I use, called M.A.C.S, that leverages these areas of supports and resistances. But you can tell that price action tends to follow where supply and demand tends to be. So you can see, we'll get rid of this drawing set and we'll go to maybe a different day in a different time. We'll do a couple more. We'll go to 30 minutes, maybe back here. And you can see here is an area and we'll figure out a couple more areas of supply and demand. So here is an area of resistance. And when you're drawing these areas of supports and demands, you want it to touch as many of the wicks as possible. So I'll draw it like this. So 1 touch, 2 touch, 3 touch, 4 touch. That this is an area of resistance. So sold off and it went back up, touched it again, fell off, touched it again, fell off. And then here it formed a lower high. So this would be the new area of resistance. An area of support, you guys probably can already tell, it's somewhere around here. So you want it to touch as many wicks as possible. Right here. Price rejected off the resistance, came back up, rejected off again, came back up, rejected off again, and then it formed a lower high. Market, which shows selling power, right? Because the buyers weren't able to push it further up, wasn't able to get higher than what it was before. And let's see what happens. We'll extend this triangle, this area a little bit further. The market stagnated in this area and broke down, right? So you can see if we were to do this from a little larger time frame, from A to a B to a C, which is a lower high, to a D all the way down here. Well, actually all the way down here, right? So you can see what I was talking about earlier. A lot of times these A, B, C, D patterns don't always happen very smoothly, right? A, B, C, and then this area right here consolidated for quite a while until it broke down. And then if you were to continue right here, as we saw earlier, this will be an area of support. You see this bullish engulfing candlestick, push it up into this area of resistance right here, sold off, try to push, the market tried pushing it even lower. Area of resistance right here, pushed it up, pushed it back down into this area of support. Market rejected it up and it broke past the previous high. Now it went all the way up. So that's just an idea. That's just one example. We can do one more. We can do like a currency. We'll about USD versus Swiss francs. And we'll do right here. Right. Here's an area of area of support all the way down here, right? Went all the way up to an area of resistance. You can see this price slowed down right around here. And then price fell back down here, lower high, came back down to this area of support. You see how it stagnated. Price failed to reject and failed to bounce off this area of support and broke back down into this new area of support. This area of support then became an area of resistance. You can see right here. You'll see later on, but this is what we call a wedge into this area of support, formed a high to a higher low, to a high, to a higher low, and broke past this area of support. And then now it's into an uptrend into this new area of resistance right here. And then we'll see what happens. Market then fell back into this area of support. You see, it stagnated and then rejected off of this area of resistance again, fell back into this area of support, and then now into this area of resistance, and then back down, and then broke past the area of support. Okay, so that's another example. We can do another one, maybe euro versus Hong Kong dollar. Maybe on the daily now. Let's go to the daily. You can see A, B, C, D, E, F, G, right? Zoom in here. A, B, C. This is our new low. This is our support level. Bounce back up. This is our new support level right here. Bounced up. Our new support level here. Bounced up into resistance. You see that resistance right here. Broke past our previous support. Now it's probably going to form a lower high, and it formed a lower high here and it bounced down. And if you focus on this one right here, which is really cool, you'll see that this area right here coincides directly with the previous resistance. Market broke up, fell back down, pushed itself up, tried retesting and tried to form a higher low, retested this area of resistance, and then now it's struggling to find a higher high. That's just another example. Okay, we'll go through multiple more examples just after we learn how to set up the trade, but you can kind of see how by learning how to read momentum, market structure, and price action, you can get a pretty good understanding of how the market is trending and where high value areas are going to be. So one final thing before we get to the really juicy part, which is learning how to actually set up our trades. And we're going to be talking briefly about indicators. There are a lot of indicators out there. My personal style of trading is that I don't use too many indicators. If you watch other YouTubers or talk to other people, everybody kind of has their own style. Everybody has their own indicators that they like to trust. My advice to you is just find indicators that resonates with you, really understand them, learn them, and then learn how to use them. If there's other indicators that you guys want to learn about or you guys want to use, let me know down in the comment section below. Okay, so my trading setup is actually very simple. I don't use too many. I just like to use moving averages to help me confirm the trends that I'm seeing. So I like to set up with the 20, 50, and 200 day moving average. So for this 20, let's go here and change it to 20. We'll keep it the same color. And then for here, let's make it 50. And then we'll make it a different color. Let's make this green. And then for the 200 period moving average, I actually like to use exponential. There's a slight difference. 200 exponential moving average just means that the days are weighted slightly different, while simple moving average just means that everything is weighted the same. So we'll make this red. As for volume, I like to know average volume on the day to know if something is over the average volume or not over the average volume. ATR is actually one of my most used. It stands for average true range. We'll talk a little bit more about that too. And then RSI, I don't use often. I usually don't include this in my chart, but it is one that I consult occasionally. All right, so you can see this right here. I'm going to click apply, and you'll see them on my chart right now. Cool. So let's just look at this. You have 3 lines on here. These are your moving averages. The blue one's your 20 period moving average. The green one is your 50 period moving average. And the red one is your 200 exponential moving average. I'm currently on the day, so this is a 20-day, 50-day, and 200-day moving average. So what do these moving averages tell us? Moving averages are basically lagging indicators letting us know what the trend is on that period. If it's a positive slope, like you see right here on Microsoft, it means that the trend is in an uptrend. Over the last 20 periods, it has been an uptrend. Over the last 50 period, it's been an uptrend. And over the last 200 period, it's been an uptrend. Nothing that we can't tell from the ABCD pattern that we learned, but it does help you confirm. And you can kind of see right here, down here, you can see the 200 period moving average is kind of turning negative because there's a lot of selling power here, and potentially meaning that in the long term or in the future, it could turn. But again, it's not a predictive indicator, it is a lagging indicator. So for us using the ABCD pattern, you might actually see that it's probably in a short market faster than the indicators will indicate, right? And just to reconfirm, you can see down here, these are all negative slopes, right? Back here, the 20 period, the 50 period, and even the 200 period are all negative. You can see it's a low to a higher low, to a lower high, back down to our area of resistance, back up to our area of support, and then broke it back down to a lower low. Again, the indicators are showing you what you're seeing. With price action, it just helps you confirm. One thing that's cool about moving indicators is that they can also act as areas of supports and resistances. You can kind of tell when there's momentum, the 20 period moving average can sometimes act as areas of supports, Same thing with the 50 period moving average, and more importantly, the 200 period moving average. So for example, if you go to the weekly, you'll see the 200 period moving average back here. We'll zoom in, access support every time I touched it. And then you can even see back here, access support. There's two main purposes, just to summarize: one, to indicate trends, and two, areas of supports and resistances. Let's move on to average volume. Average volume, I just like to add to note if there are certain days where there's more volume, more people buying and selling. And so for example, on this day, right around the 200 period moving average, this week, you can see there's a lot more volume than on average. Same thing with this one right here, which means that this move upwards is probably a very convincing move upwards. And we'll talk a little bit more about this later on when we're setting up our trades and learning when to enter the right trade. ATR, let's talk a little bit about ATR. ATR is actually one of my favorite indicators. It stands for average true range. It tells you basically the average volatility of the stock or this market over the last 14 periods. So you can see here ATR is really low, right? Why is that? ATR is very low because these candlesticks here are very small, very short. This means that there's not a lot of price movement during this time. It could be price consolidation. It could be an area of support or some resistance, buyers and sellers trying to fight it. But it tells you on this period, this stock is not that volatile. But you can see right here on this 200 period moving average area, candlesticks got a lot bigger, right? So what does ATR do? It starts shooting up because there's a lot more volatility here. And after the move has happened, you can see that candlesticks got small, volatility or average true range, ATR, average movement fell. You can see, and obviously the periods change. If you change it to a different time frame, all this information kind of changes a little bit as well. Again, these are all period based. So this is a 14 period ATR. See, very small movements, ATR sank to the bottom. Larger movements, ATR rose, right? It's a very good indicator. I'll teach you guys how to use it later on in this video. Now, lastly is RSI. RSI basically tells you if something is overbought or oversold. So if you see right here, we have two lines, 30 and 70. Anything above 70 in the red usually indicates that something is being overbought. There's a lot of momentum, maybe too much momentum, potentially indicating that the stock can sell off in the short term. Obviously, none of these indicators are going to be 100% correct. You can kind of tell, even though it's in the red, the market never sold off, right? It just means that the market, in this case, it's a momentum market, so it kept going up, even though it's in the red. Same thing down here, it's in the blue, which means that it's below 30, which means that it could be oversold, indicating that this could potentially be a good long opportunity. Again, these are not 100% predictive. These are just giving you more information to help you make better judgments. And obviously, a word of advice, never trust an indicator as your only source of information, because if it were that easy, then everyone would do it. There's also a lot more other indicators like MACDs, Bollinger Bands, right? There's a lot more. If you just go here to studies, right? You go to edit studies, there's all of these right here. There's so many. Historical volatility, right? Histograms, I don't know, half of these, honestly speaking. What my recommendation is find indicators that work for you, learn them, really internalize them, and then learn how to use them. Right? Understand their pros and their cons, because there are obviously downsides to every single indicator they're using. Now that we talked about indicators, one last thing, time period. Time frame on which you're looking at the chart is extremely important. You have to understand your objectives when you're trading. For example, if I'm day trading, I'm not going to be looking at daily charts or even 4-hour charts. So for example, if I'm day trading, I'm looking at 4-hour charts, the market's going to be over in 2 candlesticks. I'm not getting enough information. Even on the 1 hour, I get 1, 2, 3, 4, 5, 6, 7. But on the flip side, if I'm trying to swing trade maybe 30-day credit spreads or 60-day leaps, if I'm on the 2-minute, then this is way too much information, right? Like, I don't need this much information to make decisions. And so a good rule of thumb, at least for me, is that when I'm trading like longer term options, for example, 30-day DTEs, I like to start on the dailies to get better information, maybe even weeklies. Trading weeklies, maybe I'm on the 4 hours down to the 1 hour. And if I'm on the day trading, then I'm on 30s and below, because I need more information usually. And 5 is actually my preferred when I'm day trading. Really understand your objective, because the information that you're looking at will change depending on what time frame you're looking on. Same thing with your indicators. Depending on what time frame you're on, your indicators will change. Now that we have all of the basics out of the way, let's talk about how to leverage technical analysis to set up our trades. My strategy here, my system is called M.A.C.S. M-A-C-S. M stands for market trend, A stands for area of interest, C stands for criteria of entry, and S stands for stop loss. We learned how to identify the trend, right? Either it's uptrend, downtrend, or it's consolidating, running sideways. A is an area of interest. These are our areas of supports and resistances, moving averages. We didn't talk about this, but like trend lines. It's an area where we are interested in trading. C is a criteria of entry. It could be the candlestick patterns that we talked about. It could be crossovers on the moving averages. It could also be RSI, like we saw earlier. It's just an indicator or a signal for me to want to enter this trade. Now, S stands for stop loss. Every single time we set a trade, we have to set a stop loss and our subsequent take profit to understand what our risk and reward are. Let's give an example. So let's just take a look at J&J first, and let's assume that we want to trade long-term dated options or just play long-term stocks, trying to swing trade essentially. So what we're going to do first is we're going to start on weekly, and I got rid of all the studies here just so that I can show you guys how to trade with just price action, and then we can add a couple more indicators just to show how flexible this method is. But let's just jump back to maybe here. Okay. So let's first indicate what the trend is, from a high to a low, now to a lower high, and now it's back down here, right? So it's going here. So you can go, in the short term, this market is in potentially a downtrend, but it caught onto here. So maybe it's stagnating, maybe it's consolidating. Either way, let's draw out our areas of supports and resistances. This is an area of resistance. This is an area of support. It's an area of support. So we'll come here and we'll draw. Here. Okay. And now it's forming a low. Let's do it this way. Would I take a trade right here? The answer here would be no. Because why? The trend is potentially down, right? You have a lower high into an area of support. So what you would expect is for it to break further down, right? A, B, C, D. There's no guarantee that the support is going to hold. So what I would do here is I would just wait. I will wait, and boom. Now that it's formed, now that it's in this area of resistance, right? Went to a high, to a B now, right? Now it's going to wait. I'm waiting to enter a trade, boom, boom, boom. And I'm waiting for a higher low to form, or maybe even this area of support. So you know this area of support here is still going to be true. Just wait, hold. You can see how trading is a lot of it is just waiting. Because in theory, everything's clean, but in actuality, the market's quite random. So it's not as clean as it is in practice. So now it's back into this area of support. So I'm maybe interested in trading now. So now I'm waiting for a bullish signal. This isn't bullish at all. This is pretty bullish. So you could trade if you think that this is the right pattern for your setup. This could be a good entry. This next entry here is a hammer, and that could be a very good one. What I want to do is I wait for this hammer and I wait for one more candle. And on this candlestick open, this is where I would enter the trade. Now that I enter the trade, I need a little bit of help of setting my stop loss. And this is where I'm going to add one of our favorite studies. We're going to add ATR. Point out before I say anything, you see these two candlesticks right here, this bullish engulfing and this hammer? These are both higher in volume than average, which is a good sign because that's, again, another criteria of entry is that you want people to buy in. And so this is a good confirmation that there's a lot of bullish intent. So now that I've entered at 148, let's set our stop loss, our S. So our ATR is 5. So we're going to do 148 minus 5, which is 143. And this is where our stop loss is going to be. Now, where is my next take profit? Our take profit is probably going to be somewhere around this area of resistance, right? Because as price action goes up, it is probable that this area of resistance is going to cause us to sell out. So I would say right around the middle of this range right here, maybe around this candlestick right here, 162, will be our take profit. So think about it. We entered at 148. We have a 5-point stop loss. And when we're taking profit at 162, that's around a 14-point upswing or a 5-point loss. So that's a 3-to-1 risk ratio. Okay, 3-to-1. So you're risking $1 to make $3. So that's your trade setup. We'll see what happens. Boom. So I would exit right here, 162 on this candlestick right here. I wouldn't play the swing high because we know that this is a consolidating market with potentially a higher high. I would just play it up to this swing high right here, to this area of resistance, and just call it a day. Now that you know you're in this area of resistance, the market, and you're looking like, hey, I might be able to short the market. What would allow me to short the market here? You know it's consolidating. You know there's an area of resistance. What would allow you to short the market? Here is a bearish engulfing candlestick. So theoretically, you could take this trade. Let's assume that I did. Same idea here. I enter at 163. I have a 6-point stop loss now. My ATR is now 6. So 163 plus 6, it'll be 169, so around 170. And I'm going to take profit where? Down here, right? Because we know that it hasn't formed a higher high. So I'm going to wait till maybe right around this swing high right here, so 148. So I'm risking 63 to 170, 7 points, to make 163 to 148, which is around 15 points. That's a 1 to 2 risk ratio, right? I'm risking this much to make this much. And we'll see what happens. Right when it hits this level right here, 148, I take profit. I'm out. I don't need to take the end of I don't need it to take out the low of the day. I'm out. And again, if you want to trade swing highs again, you know this is a very bullish candle right here, right? You're in this area of support again, very bullish candle. You know you're consolidating. So what are you going to do? I would enter right here, 151. Same thing. What's my take stop loss? 6.5. So 151 minus 6.5 is around 145, right down here, right? And I'm going to risk it all the way up to same. 151 all the way to 162. I'm risking 6 points to make around another 12 points. That's 1 to 2, 1 to 1.75. And the market hasn't touched it. And right on this candlestick right here, I exit. Boom. Right? That's your trade. So now that it's swung higher, right now you know you broke out of this pattern. There's a couple other ways to trade this again, right? It really depends on your strategy. You know, for example, now it's A to a B. Now it broke past this area of support. I would actually redraw this area of support. Okay. You can theoretically play the swing high here, right? So you know, for example, that it broke past this area of support. So you could say, hey, I want to enter as it breaks past this area of support and play the swing high. I don't like to trade that way. I hate playing swing highs because I don't really know where to take profit sometimes, right? You got to go back really far to see if there's another support or area of support or resistance right around here maybe, right? But I just don't like to do it, but people do. Same idea. If you were to play the swing high here, you enter at 170, ATR 6, you might minus 6, and you play it all the way up to the swing high to 180, area of resistance right here. And you're done. You're out. You can see how beautiful price action is if you understand market structure. This is just plainly building off a market structure. That's it. We can do another example, right? We can do, let's just Microsoft, for example. Now, in this case, let's add in our indicators. Let's assume that I like to trade at the 200 period moving average because that's an area of support. I don't have enough data here, but let's assume that here we know that it's in a downtrend because your moving averages are sloping down. Right? 20 and 50 moving averages are sloping down. So what I want to do is I want to look for a bullish, maybe reversal pattern because I'm looking and I want to trade off of the support on this 200 period moving average. So what you would do, for example, right here is look at potentially this trade right here. You see there's a bullish engulfing. So on this candle, you would enter the trade right on 111 and your ATR 17. So you're at 241 minus 17. So that's around 224. Will be right down here. It's pretty low actually. And where might take profit be? You need to take profit at 20 period moving average because you think this is a area of resistance. Let's assume that you did that. 20 period moving average 252, which is around a 10 point. So you're risking 10 points. You're risking 17 points to make 10 points. So that's not a great trade. So you probably wouldn't take this trade, just unless you widen up your take profit. So now you choose to widen up your take profit to 265 because this is the previous swing low, right? So 265. Now your take profit is 20 points versus a 17 point stop loss. That's a 1-to-1, a much better trade. Let's do another one. 20 period moving average here. What you're looking, I want to enter. But none of these are very bullish confirmations, right? This is a large engulfing. This body never broke past it. You have 3 black crows here, so maybe you can do that, but then you're hitting your resistances, so maybe not. Boom. So this is where I think you can enter, right? Look at market structure. Zoom out just a little bit. After every single move, you have to recalibrate your trend. You know, before it was A, B, C, D. Between the support, now it's a D. And it might form an E. We don't know, right? We might form a lower high. It might form something. In this case, it formed a higher low and then pushed up to a higher high. So it became A, B, C, D. Now we're definitely in an uptrend. This trade you probably wouldn't be able to catch, in all honesty, the bullish engulfing candlestick using the weekly time frame. But there is another way I'll show you guys shortly after. But you probably wouldn't be able to catch this. However, you could theoretically enter this trade maybe on this candlestick right here at 276. A bullish engulfing candlestick with big volume. That is your C. Great. Next candle open, let's go in. You can see right here, now the RSI is at 17. We do the same exact thing. 280 minus 17 is 263. So right at the bottom of this previous resistance. And in this case, let's do a quick exercise. Let's assume that we do not actually have another high on Microsoft. And Microsoft is at an all-time high, and this is just going to push up higher and swing higher, theoretically. So how do I set my take profit? I'm going to show you guys a couple ways. The first one, I'm going to do it the way that I like to do it, the easiest way, which is I'll set my trailing stop loss instead of a take profit. Okay? I'm going to trail my stop loss with this 20 period moving average. And whenever it crosses that 20 period moving average, then I'm out. On this candlestick right here, I'm out. I would probably make a decent amount of money from like 278 all the way out to 320. So 40 bucks for a 17-point stop loss. So almost a 1 to 2, slightly more. The other way could be you ride this wave until you see signs of weakness. So which would be, let's go all the way back here. No weakness, no weakness. This is not really weakness, right? You don't see any bearish signals. This is very bullish, no bearish. Doji is the hammer, not really bearish yet. Not really bearish. Right here. This is a bearish sign. This is a shooting star, right? And so I would exit on this candle right here. And so that way you can exit a little bit earlier, but you would probably never be able to time the top. I'd probably exit somewhere around 340. You eke out an additional maybe $13 on this one trade. Cool. Another way people like to trade is sometimes they use RSI. So whenever RSI crosses to be oversold, or overbought above 70, then they exit. So they would exit right around here, which is 320. Very similar to where it would be if we had the moving average on the 20. Okay? So that is just one way you can trade if you don't necessarily have a good take profit level. Other people use Fibonacci extensions. There's a lot of ways. Same concepts apply. Stop loss, take profits, trends, areas, resistances, and criteria of interest. Now, remember the comment that I said you probably wouldn't be able to enter this trade on the weekly candle because this is really hard for you to enter on this candle. You probably enter on this candle. But there is a way. So I'm going to use on demand to simulate back to this time frame, and I'll show you how we would do it. So we're going to go to the day. And we're going to zoom in right here. This is the area, right? We're going high to a low to high in a area of resistance. Slightly higher, but I usually just don't consider that. And now it's forming into this area right here. This is a area of potential support, maybe. But you can tell from the market perspective that this might be an area of support. You see some buying power coming in and the price is consolidating here. You see ATR is falling down. If you want to trade the higher low, this is possible right here. I personally wouldn't because this isn't a very bullish signal, but let's assume that you did. 251 minus ATR of 6 because you've entered on the daily instead of weekly, so you use the daily ATR, so 6, so 252 minus 6 will be 246. You'll be right down here, and you would probably trade it up to the swing high at 273. But I probably wouldn't. It's not very bullish, so we'll just keep going. We'll just wait and wait and wait. And then this one right here. This is very bullish. This is a bullish engulfing candlestick with more volume. This is a good sign. So here I would enter this trade on the next candlestick opens, which would be right here, 255. And then I would have a stop. I would have a ATR, stop loss, again, 6. But now we're on the daily chart, so we're using daily ATR. So 256 minus 6 would be 250. And then I would probably swing it up to the swing high around 253, right around probably here. So I would risk around $6 to make around $14. So about a 1 to 2. Pretty good trade. So let's do one more. We'll go back to SPX. We'll try to day trade this just to show you guys how this is done on a smaller time scale as well. Go to SPX now. And let's go down to 30. And let's day trade this area that we saw previously. Let's go here. Okay, maybe you're thinking this is resistance. You can either go up or down, right? But you see this bullish engulfing candlestick here, and you're like, oh, maybe I can enter on a bullish try. Again, this is probably not a trade that you want to take, because why? You are entering at 648, your take profits all the way down to here, but your risk is up to here. You wouldn't take this trade. Remember, always remind yourself of the risk and reward. That's why technical analysis is helpful, because it allows you to understand what is doable and what isn't. Now let's trade what we were talking about previously. You want to trade this break of structure, right? You're going, hey, A to a B to a C, and if this breaks, this could be a swing lower. Now, what would I do? I would look for bearish intent. So this one right here is pretty bearish, and then this one right here is very bearish. So I would then swing low and then trade on this candlestick right here. So it'll be 630 minus 1 ATR, which would be 10. 640, 6440 will be right here. And then where would my next swing low be? Let's zoom out. Where would my take profit be? Let's go to an hour time frame. And you can see maybe the next potential area of support might be around here, 6400. The concept here is that previous areas of supports can become resistances, and resistances can become supports. So what you would do here is you would trade probably from here all the way down to 6400, which means that you are risking making 30 bucks and risking around 10 bucks. So 1 to 3, that's pretty good. Obviously, the market broke down further to 63.43, but most people I think would take this trade. You can always have one runner run. So for example, if you had 5 short shares here or 5 puts, you would sell 4 or 3 and have 2 of them run, see if they can get any lower. Just to show you that TA isn't perfect, you're going to lose a lot of trades regardless of TA. Let's do an example. Let's do this. You're in a downtrend, right? Pretty obvious downtrend. So now you think that the market's going to continue to go down. A, B, C, D, E, F, G. Now this is an area of potential resistance, right? You're forming a lower high, 50-period moving average into a potential higher low. And the market seems to be selling off. So I'm going to take this entry right here. This entry looks pretty good. Large engulfing candlestick. So I'm going to enter on this candlestick right here. 63.49. I'm going to subtract ATR of 5. So add it. So 63.40, 63.70 plus 5. So 63.75. So right here. If I'm looking just at this, right, it's highly likely it's going to break down. Now, what happens next? It breaks up and I get stopped out. It happens. But take profit is here. Stop loss is here. Not every trade you enter will win. That is just the ultimate truth. You can look for the best setups. The market, unfortunately, is going to be random sometimes. It is going to make you lose. Even though this trade setup looked really good, right? You see a bearish engulfing candlestick, and the next one is next candlestick open. You're like, I'm going to short the market. You went short, market immediately rebounded, and you lost. It happens. And we're just going to do a couple more just to really emphasize this point that TA is not going to make you perfect. Other people probably won't tell you this, but trading is really about how you manage your losses. So for example, let's go back to J&J right here. J&J, we already mapped out. We won't do too much. Let's assume that here you want to trade this resistance right here. And you're like, hey, let's zoom in right here. And you're right here. You're going, oh, this is actually in this new resistance, right? This previous high. I see this red candlestick here is relatively large. R size pretty high. I'm going to try and short the market here. So on this candle opening, you short it. So 160. 160 plus 6 is 167. So you're up here. And the next candle, it breaks up, and you're out right on this candlestick right here. And you lose. Right? There's nothing inherently wrong with the trade that you just took. You saw a confirmation, you waited for an area of resistance. I know there's a strong upswing here, but your hypothesis was that this is going to reject off the resistance. Completely fair. But unfortunately, the market had other thoughts, and it rejected and you lost. The worst thing you can do here is if you move that stop loss up. A lot of us don't like taking losses, and this is why we're working really hard to learn TA. I understand that, but even with TA, you will lose. It's just part of the game. Let's do another one. Let's just go to a random chart, right? Let's just go to AVGO. You say right here, you see this is a previous resistance, and then now it's bouncing up into 200 period moving average. Resistances can turn to supports, which is great. And so you're around 200 period moving average right here, and you go, hey, maybe I can enter this trade. This is a relatively bullish candlestick, 200 period moving average, 50 period moving average into an area of support, resistance that could turn to support. So you're like, hey, this might bounce up. It's in an uptrend. Let's go bullish. Completely fair. So this candle may not be the most bullish, but it is still a large price rejection off of the 180 price level. So you go, let's go candle open at 188. Let's go long. So your ATR is around 20, 188 minus 20, 168. So down here. And let's see what happens. Boom. Immediately 2 candlesticks afterwards, you lose. Let's assume here you're like, hey, this is the trade I was actually looking for right here. 160. Area support, large bullish engulfing candlestick. Great. Great signal. I'm going to enter on the next candlestick. Next candlestick opens right here, 171. Let's go long. 184. And I want to play the swing up to this previous high right here, 250. So I'm going to risk around another 24 for this 240, right? So that's a pretty good risk to reward. And guess what happens? This one you win. You never really know. Sometimes you enter a little early, right? Sometimes you enter perfectly. TA is not going to be perfect. We can do another one. Let's just do AMD, for example. Let's assume that you're trying to trade a higher high, right? This is an area of resistance into an area of support, right? A to a B to a C to a D, right? Now forming an E. Trend is up. You're doing this 50 period moving average into an area of resistance that can turn to support. That's great. This looks pretty positive. This right here is a great pattern, right? We learned about this. This is what we call the morning star, right? Really bullish and bullish reversal patterns. You enter this trade on the next candle open. 164 minus 14, play to the swing high of maybe 220. Pretty good trade. What happens next? Boom. You lose. The move didn't happen and you lost. There are a lot of times where in the market, you will lose. That is unfortunately true, right? And we'll talk more about the psychological part of it, but this is just to prove to you that no matter what happens, TA is not infallible. You will end up losing trades, even if the setup looks great. I know that was a lot of charting, a lot of explanation, so if you guys need to revisit that part and just run through it a couple times, make sure you do. Obviously, some of those were cherry-picked, other ones were done live, but I want to simulate as much as I can in a live environment. That is actually what's going to happen when you trade, because the charts or the live charts is not going to be perfect. So if you need to revisit that section, feel free to. It is there for you. And if you guys want more examples of my trades using the same exact methodology, here's a playlist of some of my trades. I trade predominantly credit spreads because, I don't know, it just vibes with me better. I've also done leaps. I've also done single options. Let me know if those interest you. I can post more of those, but overall, you can see the consistency in the way that I trade, especially as time has gone on. Again, very important point I want to stress. TA is not perfect, right? It is just a framework. You can see even when we win trades, we have a framework. And even when we lose trades, we have a framework. The last couple of trades that we went through like pretty quickly, when we lost, those are probably the most important trades that we went through. Do not move those stop losses, okay? I'll repeat this in like the end of this video when I talk about like my experience and tips, but do not move those stop losses. That's going to ruin your P&L 100% of the time. Speaking of losses, I want to stress why that's so important by walking you through how to become profitable with just plain straight math. As an example, if I win $150 every single time I win and I lose $100 every time I lose, that's about a 1 to 1.5. Let's say that I win 5 times and I lose 5 times. Right? I have a win rate of 50%, which is not great, but it's not bad. I would end up making $750 and I would end up losing $500, which means my ultimate P&L at the end of 10 trades will be $250 positive. What happens if I up this loss, because I move my stop loss up to $200? Let's say I win more often and I lose less often because I'm increasing my lower limit, right? So I should lose less often. So now my new math comes out to be this equals $900, but now I'm losing $800. So I'm actually only up $100 as opposed to what I was before, which would be $250. I'm worse off by $150. So this is why it's important for us to control our losses. Let's assume that this is what a lot of people end up doing here. A lot of people end up going, hey, I don't like to lose. So when people win, they win very little. They win $100. And when they lose a lot. They lose $300. You guys are great traders. You guys win 7 times and you lose 3 times. You guys can see this one you made $700, and this one you win $900, right? You lose. Overall, your P&L here is negative 200. You might win more, but you end up winning very little every time you win, and you lose a lot every time you lose. So ideally, what we want to do is actually this. Let's assume we maintain that 2-to-1 risk to reward. So we win, we make $200, and when we lose $100. Let's assume that we had a really bad month. I only win 3 times and I lose 7 times. It happens. Okay, we have bad months. In this case, I make $600 and I lose $700. I only end up losing $100 on a very bad month. I only win 30%. This here is the most important thing we have to control. How big our losses are. How many losses, not as important, but how big our losses are. If you have some very large losses, this is how you blow up your account. If you have many large losses, this is how you end the game. If you have many little losses, this is how you end up becoming consistently profitable over time. The trade setups that we look at are very important. We never take trades that are like 1-to-1 or anything less than 1-to-1 because it doesn't make any sense for us to do that. We want to try and find our edge by making sure that our risk is worth the reward. And this is exactly why TA is important, because it allows you to set up your trades in a way where your risk and your reward are well known so that you know what you're doing before you enter the trade. Okay, and just real quickly, I'm including a resource document in the description below, all the tools that I've used in my trading career. Keep things simple: brokerage account, charting platform, journaling app, or just the notebook. But if you guys ever have any questions or need resources, just click on the link below. We will have to practice these skills in real life, which means that my recommendation is if you're brand new, you learn how to trade by starting with paper trading, fake money. Thinkorswim, for example, the platform that we were just using, has this feature called On Demand. You can go back and simulate trades and trade with fake money to make sure you guys understand the concepts in its entirety. My advice here is if you're paper trading, trade it like as if it were your own real money. Try to simulate following the strategy, simulate taking losses and taking profits so that you can get used to the mechanics and reading the charts as you would in a real trading environment. Once you guys feel you're ready, you guys can trade in the real market. And here is the tip. Trade with just a little bit amount of money, right? Trading is a very difficult skill. You have to learn how to trade. And I promise you, when you go from paper trading to real trading, it will feel entirely different because now you're dealing with real money, your own money, and you will feel a lot more emotional stress because you are dealing with real money. Practice small, start small. Which leads to the most important tip for beginners and actually everybody who trades is that you have to journal. Journal is like film study when it comes to sports. Every time you take a trade, write it down, figure out what you did well, what you didn't do well, figure out whether or not you saw the right patterns, if you're trading the right setups. Try to write down everything you can so you can learn from your mistakes. This channel, Credit Spread Investing, I actually started it as a way for me to journal. I did video journals. But even today, every time I day trade, I write it down in my notebook and I reflect on what I do well and what I don't do well. That is how you improve. Trading is a skill, and especially for beginners, the most important thing is to remember this is a marathon, not a sprint. This comes to the final section, and this is going to be a little bit more unedited. I want to give you guys a little bit about my experience trading for the last maybe almost decade now. Technical analysis is not going to make you profitable overnight. There is no such thing as a foolproof strategy. that it's always going to let you win. Technical analysis is really just the building blocks and foundations for us to try and find an edge in the market by finding the right setups, being able to minimize our risks, and maximize our rewards like we saw in this video. But that's just the technical side of it, right? Finding these setups. And even then, you can tell from the practice session that we did here that a lot of times in reality, the setups are not as clean as you would want it. A lot of it comes down to our experience. A lot of it comes down to our decision making. In theory, everything is very clean, right? But in reality, in practice, we have to be able to notice and find these patterns and come up with an entry and exit plan as fast as possible. And that is no easy task. That's why experience and discretion is honestly the most important tool and the edge that you guys will have to build throughout your trading career that will allow you to become consistently profitable. That is the goal. We don't want one-time wonders. We want to be able to do this for a career. And honestly, I honestly think that you guys can do it. I've done it. It took me a long time to do it. It took me around 7 years. But once you build the experience up, it is absolutely doable. Which leads me to, I guess, the ultimate maybe tip that I want to give you guys. Trading is an emotional endeavor. It is probably one of the hardest things that I've had to learn maybe ever. And you guys will come across these situations too. And you guys can refer back to this video and be like, yeah, I felt the same way. But I'll give you guys a couple examples. Even with TA in our setups, you set your stop losses and you set your take profits, right? And you have high confidence in this trade. What happens if the market immediately reverses and sells off into your stop loss? There's a lot of times where in my trading career where I go, oh, I still have confidence in the move, right? This move looks so bullish. I'm going to move my stop loss, I'll move it down. So I increase my risk. Market keeps dropping, I further increase my risk. I keep dropping it. I don't actually want to realize the loss. I don't want to take the L. Right? And research has shown that taking losses is probably one of the hardest things for humans to do. And for me, that is absolutely true. Right? Because the moment you close that trade, your bank account goes negative. And then ultimately you take a very fat L because you can't hang on any longer. Or on the flip side, it goes up to your take profit and you look at the charts again, you go, oh, I can probably make more money on it, right? I think it will hit a higher high. So I'll move my take profit up to another level and we'll see a run. I have high confidence. But what ends up happening is the market may move up a little bit, but then it falls right back down, right? And then you go, well, I could have made more money. I'll exit the next time it hits my take profit, my initial take profit, and then I'll exit the trade. But then the market never does. And so you turn a winning trade into a losing trade. You weren't willing to realize the gains in the beginning. And I've done this many, many times in my trading career. And I'm sure anyone who has ever traded will come across that situation, that exact situation. Trading is really about discipline. It's about trying to find consistency, trying to figure out how to deal with the emotional distress or this emotional turmoil that comes with trading. The psychology of trading, learning how to manage your own emotions, is probably more than half the battle. Greed and fear will dictate your actions more often than you think. And this is why ultimately trading is so difficult. It is a very hard skill to learn. It is a skill. It will take time, it will take effort, and it will take discipline. There has been so many studies that have proven trading is a very hard thing to do. There's a study in 2000 that showed that most day traders around the world, they actually underperform market. An even more recent paper showed that 99% of all day traders fail to make consistent profit. I'm not saying this to scare you. I'm telling you this so that you don't get sold on the hype when someone else inevitably comes to you and sells you on the dream that by buying his course or her course or by following this system, you will be profitable. It is not that easy. Right? And I don't want to scare you. I'm trying to be as honest and transparent as possible. This skill took me years and years and years to learn. And even today, I am still learning. I'm still growing. I'm still trying to improve my edge each and every day, each and every single time I trade. Hopefully that section was helpful. Let me know. I do want to make a how to become a good trader series. Again, let me know down in the comment section below if you guys have any thoughts, your own experiences. Love to hear from you guys. So that about wraps up this course. I'm going to link a form in the description below. to ask for some feedback on this video, as well as what you guys want to see from the future of this channel. So if you guys can fill that out, that would really help the channel out. And if you guys like the video, learn something, do consider liking the video. And if you guys like content like this again took a long time to make. Hopefully trying to be as transparent as possible. Hopefully it was helpful. Make sure you guys subscribe to the channel so that you guys can have the best information on the internet. Oh, and lastly, this is a brand new office. I love this office. If you guys ever need interior design help, Regina helped me here. I'll link her contact information down below as well. Again, if you guys have any questions, let me know down in the comment section below. If you guys have anything you guys want to comment on, again, drop it down below. But thank you guys so much for taking the time. I know this is a very long course. Hope you guys learned something. And if you guys want to learn how to trade credit spreads, if you guys want to learn how to sell options, which is what I did for many, many years and what's allowed me to retire early by leveraging technical analysis, make sure you guys click on these 2 videos in the end screen right here. And if you guys want to see more of my trades, I link that playlist in the upper right-hand corner. Click on it. And until next time, stay safe in the market.